Maybe it's due to the high upfront costs of a down payment or the assumption of debt in the form of a mortgage. But many people shy away from this asset class, not realizing how lucrative buying and holding real estate can be. And in this video, I will share with you everything you need to know about how to properly decide whether to buy or rent a home. I will share with you 4 reasons you must invest in real estate. Video, we're going to follow the journey of my friend Steve. Steve is a 25-year-old computer programmer living in Seattle. After graduating from college a couple of years ago, Steve has been working hard to climb the ranks of the IT company he works for while trying to save as much money as he can. You see, while Steve loves his parents, he feels as though living at home is cramping his style and is looking to move out on his own. Steve knows that this will be one of the biggest financial decisions to date and decides to talk with his family and friends to get an understanding of whether or not he is better to buy a house or to rent. So one weekend, Steve sits down with his parents and explains to them that while it's been great living at home, he wants to start a life on his own and wants to get their opinion on whether he should buy a place or rent. Steve's parents, being from the generation of steadfast homeowners, begin to explain that renting is a waste of money and that the choice is clear that buying is better than renting. They explain that owning a home has numerous benefits that renting simply cannot offer. Steve's mom started explaining that when you own a home and begin making mortgage payments, you build equity, which is the portion of your home that you truly own and isn't encumbered by a mortgage. So each monthly payment takes you one step closer to owning your own place, something renting cannot give you. Secondly, she explained that over the long term, owning a home is a wise investment. Steve's mom explained that they bought their home 25 years ago for $150,000, and it's now worth $450,000. She asked Steve what other investment would triple his money in just 25 years. In fact, Steve's mom told him that the general rule of thumb is to hold a property for 5 years or longer in order to reap the full benefits of the home's appreciation. Now, being a protective mom, she also stressed the importance of housing stability. Steve's parents would never want to see Steve living on the street, and they stressed that owning a home means much more predictability. In fact, even fixed-rate mortgages help ensure financial stability when it comes to owning your own home. Finally, Steve's mom brought up the fact that when you rent, you are under the watchful eye of your landlord. Steve figured that he is micromanaged enough at work, and having to deal with more of that behavior at home may be an issue. Steve's dad then chimed in and was quite adamant on just how ridiculous it is to rent if you can afford to buy. He brought up the fact that renting is simply paying someone else's mortgage and making them rich instead of building your own wealth by investing in a principal residence. He also asked Steve if he was willing to continuously move if his future landlord wanted to live in the unit. He explained that when you rent, while you may have rights as a tenant, the landlord can ask you to leave with proper notice, meaning that you have to deal with the hassle of moving more frequently than you'd like. Moreover, if there aren't proper rent controls in place, then your landlord can jack up your rent and make an initially acceptable rent cost now out of reach. After sitting down with his parents for a couple hours, Steve was beginning to sense that buying a home was the right decision. But being the analytical thinker that he is, he wanted to get a second opinion, so he called up his friend Jessica to see if she had time to chat. About a week later, Steve and Jessica grabbed coffee, and Steve began to ask Jessica why she chose to rent over buy when moving out of her parents' house a couple of years ago. She said that unlike Steve's parents' advice, there are actually many benefits of renting that he may find appealing. First, she explained that renting is generally cheaper than owning a home. She explained that rent payments are often less expensive than mortgage payments, and that rent can include other expenses such as utilities, hydro, cable, and internet. She also mentioned that renting offers you a flexibility and lifestyle that buying a home simply wouldn't. Jessica explained that most leases are 1 year, meaning that if you aren't in love with your living arrangements, that you can bail out and look for a better accommodation. Alternatively, if you do ride out a year's worth of lease, then most landlords will allow you to go month to month, which is about as flexible as housing can get. Now, to counter Steve's parents' point about having to constantly move, she mentioned that it's possible to score a multi-year agreement, which is often beneficial as it ensures your housing stability and can be used to negotiate a lower rent cost with your landlord. Next, when you rent, there is little to no maintenance that you need to worry about. If your washer breaks or a smoke alarm needs to be changed, you can simply call up your landlord and it will fix it for you. Finally, as she previously mentioned, renting is typically cheaper than being a home buyer, and with these freed up funds, you can invest the difference and see your wealth grow. Maybe you will use this money to buy a rental property or send the extra cash into your retirement account. Either way, you are making steps in the right direction to improve your financial position. Jessica then asked Steve if he's looked into how much it actually costs to buy a home. Steve sighed, as he was embarrassed that he had no idea how much homeownership would cost him. Jessica explained that the financial aspects played a big role in her decision to rent, and then went on to explain the 4 key costs of being a homeowner. The first of the 4 main costs of homeownership actually comes before you buy the home, and this is the down payment. Down payments typically range anywhere from 5 to 20%, and you will need this lump sum of money to apply for a mortgage. Now, saving up 20% of a home's cost can be tough, and many people decide to buy without having this much saved. However, when you buy a home with less than 20%, you will be subjected to private mortgage insurance, or PMI for short, which is another cost that gets tacked onto your housing costs. If you're unfamiliar, PMI is a lender's protection in the event that you default on your primary mortgage and the home goes into foreclosure. The next cost associated with owning a home are the closing costs. When you buy a home, there are a lot of administrative tasks that need to be completed, and this cost is roughly 1.5 to 5% of the total home's price. These costs include lawyers' fees, appraisal fees, home inspection fees, and property tax adjustments. Now, once you own a home, you will need to insure it. Home insurance can range anywhere from $50 a month to hundreds, depending on where you live and the size of your property. Finally, there are maintenance costs. When you rent, you can avoid this cost completely, but when you own, you need to upkeep your property. A general rule of thumb is that maintenance of your residence will cost you anywhere from 1 to 2% of the home's value every year. After Jessica's explanation of the 4 key costs of being a homeowner, Steve began to feel overwhelmed with all the costs he would have to assume if he decided to buy a home. After returning from coffee, Steve decided to research a little bit further into what factors to consider when making the decision to rent versus buy. He came across a handy checklist of considerations for both renting and buying. Situations where renting made sense include when you aren't ready to settle down and don't know what your long-term plans are. For example, if you might go back to school, take a job promotion in another country, or your job situation isn't stable, or when you can't afford the monthly carrying costs of home ownership, and finally, when you're carrying high interest debt. Focus on paying that off first before buying a home. It makes little sense to borrow money for a mortgage when you're paying 19% interest on your credit card. While some of these points resonated with Steve, he continued to the list of situations where buying made sense, such as when you're ready to put down roots and are committed to staying in the same place for 5 years or longer. Or when you're ready for the responsibilities of being a homeowner, and when you're ready to make financial sacrifices. You may not be able to afford to go on multiple trips a year when you're a homeowner versus when you are renting. If travel is highly important to you, you might be better off renting. After talking with his parents, Jessica, and researching online, Steve came to the conclusion that homeownership wasn't for him and that he would be better off to rent. You see, Steve has aspirations of traveling more in his 20s and early 30s, and feels like being tied down to home ownership responsibilities would impede his ability to be mobile. Moreover, Steve is a rather high maintenance guy who would rather pass off any issues he has with his living quarters to a landlord, making the option to rent that much more appealing. Now, you may be wondering, Betterment Boss, where do you land on the buy versus rent debate? Well, like many, I grew up with my parents harping on the importance of buying a home and all the benefits I would gain from being a homeowner. From pride of ownership to the development of equity, they made some great points as to why owning a home is beneficial. However, after expanding my financial horizons, I came to realize that renting can also be a very viable option. What I love about the idea of renting is having less stress around the upkeep of a property. When I have rented in the past, I loved being able to call my landlord at any time of the day to come fix any issue I was experiencing. I highly value convenience, which is why for the time renting was perfect for me. However, over time, buying a home has grown in appeal for me. While I don't see a home as an investment due to all the costs that comes with homeownership, there's really no doubting that it is a good vehicle to park your money into, especially in an economically stable city like the one I live in. This is why, for me personally, I think that if you plan to live in the same city for the foreseeable future and have the money for a down payment, then buying a home is the right decision. But then again, that's just my opinion. Ultimately, you now have the information you need to be able to make a decision on whether you should buy or rent a home. What I suggest is talk to other people who have done both, do your research, and then ultimately you'll be in a great position to make one of the biggest financial decisions of your life. Thanks for watching. If you want to go from the life you have to the life you deserve, then hit the subscribe button now. Now, before we get into the financial benefits of using real estate to grow your wealth, I think it's important to go over a few reasons why owning real estate makes sense as an investment option. You see, from a common sense standpoint, there are some surefire reasons why real estate makes for a great investment choice. The first is that everyone needs to live somewhere. Whether you are renting or own the home you're in, we all need shelter as a basic human need, and investing in an asset that is needed by more than 7 billion people on Earth just makes sense. Now, while the need for shelter grows as the population expands, what doesn't grow is the space for housing to be built. The Earth only has so much free space to build on, and as supply of houses decreases, the prices of housing increases, meaning that the property you invested in will only rise in value over time. Not to mention, unlike digital assets, no one can hack or copy your house. It's a physical property, and as long as you maintain adequate insurance, you can be sure to continue to benefit from its appreciation over time. Now, without further ado, let's dive into the 4 reasons that real estate will help you build your wealth and allow you to build your dream rich lifestyle. Reason number 1, ongoing cash flow. Let's use an example to illustrate the cash flow that you can obtain by leveraging the power of real estate. Assume that you find a 3-bedroom home for $300,000 that you want to buy and rent. A residential property of that size in an average city can house roughly 3 people, meaning that you can have 3 different tenants under one roof or have a family inhabit your house. Now, chances are you don't have $300,000 in cash lying around, and you must borrow money from the bank in order to cover its cost. This is normal, but the bank won't just give you the total value of the home. You will have to contribute a portion of the total cost through what's known as the down payment. To avoid private mortgage insurance, you typically have to put down 20% of the down payment yourself, with the bank floating you the rest at the stated interest rate. Therefore, on a $300,000 home, you need to come up with $60,000 for the down payment and a few $1,000s more for closing costs. Luckily, you are a diligent saver and have the cash on hand to cover this amount, and accept taking on a mortgage of $240,000 at 3% interest for 25 years. Using these numbers leaves you with a monthly mortgage cost of roughly $1,100. Now, when you own a house, you will also have to pay for home insurance and property taxes, which usually equate to 1 to 2% of your home's value, or in our example, would be $3,000 a year. Split up over 12 months would increase our fixed expenses to roughly $1,350. Not to mention, there are upkeep costs that you need to bear as a landlord, and these will run you another 1% of the home's property value, bringing us up to $1,600 a month in fixed fees. Once you have these fees covered, the home now becomes inhabitable for a tenant or group of tenants, which is where the revenue side of the equation comes into play. Let's say you can rent that property for $2,100 a month to a family of 4. Every month, you would be collecting $2,100 in rent payments, which would be offset by the $1,600 in fixed fees that property will cost you, for a net cash inflow of $500 a month. While $500 may not seem like a ton of money to profit per month, when annualized, it's $6,000 that you otherwise wouldn't have. But it gets better. That's $6,000 is your return on an initial investment of just $60,000, meaning that the property is netting you a 10% ROI. Another thing to keep in mind when it comes to the cash flow produced by real estate is that over the years, rents will increase, meaning that the $2,100 you are charging now will become $2,200 and $2,300 over time. And with your mortgage payments staying the same, you will be profiting more and more every single month. Reason number 2, equity formation. When you break down what it means to own a property from a financial standpoint, you are effectively paying down debt in exchange for full ownership of the unit. In the example I just used, this would be the $240,000 mortgage that you assumed when you bought the 3-bedroom house. So in effect, when you own a piece of real estate, beyond the profits you may realize every month, you will also enjoy the equity that has been created in the home once it is fully paid off. The best part is that if you are renting out this property, then you won't be on the hook for any of the cost. Every time you receive rent from a tenant, part of that money is going to be going towards your mortgage. And when you go to sell the home once it's fully paid off, all that equity you've formed over the years will be yours to keep. So after the 25-year amortization period ends and you have fully paid off the property, you'll be getting back $240,000 in equity, which is roughly $9,600 a year in your pocket, not accounting for the time value of money. So when you add that $9,600 a year to the $6,000 in profits you are receiving from your tenants every single month, you will have a net increase in wealth of $15,600. Remember, when you originally bought the home, you only put down $60,000, which means that before maintenance costs or repairs, you would be realizing a return of 26%. That's much higher than the historical average stock market return of 7%, and while being a landlord can come with some headaches like chasing rent payments or dealing with housing emergencies from time to time, this is worth the hassle if you can secure double-digit returns. Reason number 3, appreciation. Now, beyond just collecting rent and paying down your mortgage, the next way real estate can build your wealth is through appreciation. Appreciation is defined as an increase in monetary value, and it's when the value of your house increases over time. In the United States, the historical average of appreciation for residential properties has been 3.5% annually, which means that a year after buying your $300,000 home, it would now be worth $310,500. Keep in mind that this is just the average, and that the appreciation rate could be even higher depending on what city you live in. Now, you may be thinking that this $10,500 rise in appreciation is a substantial gain in property value. However, this is just the tip of the iceberg. Let's look at this appreciation over a longer time horizon. If we use a compound interest calculator and put in the cost of the home, which is $300,000, at 3.5% over 25 years, we get a future value of $708,974, for a total appreciation of $408,974. This amounts to an annual rise in value of your property of $16,359. So now let's tally up how much your property will be increasing your wealth on an annual basis. From a cash flow standpoint, we know that you will be collecting $6,000 a year in profits. Moreover, you will be building $9,600 in equity via the payments your tenants are giving you. Then, with historical returns being used, your home would be providing you $16,359 in appreciation for a grand total rise in your net worth of $31,959. That's a return of $31,959 on an initial investment of just $60,000, or just over 53%. One thing to keep in mind is that this is not cash in hand every year. Only the profits received from rental payments will be money you will physically possess, as the rest of the financial benefit will be on paper, as financial experts would say. Now you are probably grasping just how lucrative owning an appreciable asset can be, but what might amaze you is how fast your net worth rises as a result of this savvy investment decision. You see, there is something called the Rule of 72, which I've talked about in a past video, and it's an easy way to calculate how long it will take you for your money, or net worth in this case, to double. 72 divided by your annual return gives you the time it will take in years to double your money. Given that you are realizing a return of over 50% a year, that means you will be doubling your net worth consistently in less than 2 years. And this is just an example where you own a single property. When you consider that you are earning $6,000 a year in profits from your tenants, in another 10 years you could buy another house with the $60,000 you've amassed and duplicate this money-making process. Reason number 4, tax breaks. We've already gone over ways that real estate can make you money. However, one thing many people overlook are the tax breaks that one receives when owning a property. These tax breaks include not only ways to reduce your taxable income, but methods to maximize the proceeds you receive when you sell your property. When it comes to your annual tax bill in the United States, you can deduct all repairs, insurance, legal fees, mortgage interest, and homeowner fees, which unfortunately are all costs associated with a home. Using our prior example, that $25,200 you are earning annually as rental income, which is the $2,100 a month we talked about earlier, can be netted against your costs of maintaining the property. Given that you will be earning a profit through your rental property, you will need to pay tax on a portion of these returns. What I suggest is that you put aside a large percentage of your real estate earnings to cover your tax expenses. This way, when the tax bill comes, you can cover its costs with ease. And if you have oversaved for this expenditure, then you can keep the residual amount for yourself and use it to buy your next property. Now, there are 2 other ways of managing taxes that will result in the highest returns possible when embarking on your real estate investment endeavor, and both relate to the disposition of your asset. If or when you decide to sell your property, you will be incurring capital gains, which is the difference between the selling price of the home and its initial cost. So in our example, we bought the house for $300,000, and if we were to sell it years down the road for $500,000, then our capital gain is $200,000. Paying taxes on this difference could mean giving up tens of thousands of dollars in proceeds, which is where the primary residence exemption comes into play. If you live in the property for 2 of the 5 years prior to disposition, You can sell the property and use your Section 121 capital gains exemption, which allows you to avoid $250,000 in capital gains on the sale of the real estate. In this example, you would pay no tax and keep all the cash you make on the sale. The other tax management strategy is to use what's known as a 1031 exchange, which allows you to sell a property, and if you buy another property within 45 days, avoid the capital gains that would come as a result of the sale. Either way, you want to minimize your tax burden when operating or selling a home if you want to maximize your overall wealth.